Ladies and gentlemen, welcome back to the Finstep Asia Edge podcast. With me today is a friend, a mentor, and a star of Indian Fintech, the guru Amit Goel. Welcome, Amit. How are you doing today?
Thank you, Musheer. I'm doing well.
We are seated here in the WeWork offices in Bangalore, or Bangalore as some of us still call it. Amit is the partner at 77 Capital. He has been looking at Indian Fintech over a long period of time and also investing in some star names. We'll go through in more detail about that. Amit, your journey in Fintech has seen various different aspects to it, right? From being an entrepreneur to initially being a consultant to being an entrepreneur to now getting into investing. What has this journey been like for you? Like, how did it evolve broadly?
Okay, so I had spent a lot of time outside of fintech. I grew up in a totally different world.
Sure.
Yeah, but in 2012, I met my co-founder in the US, who was actually into fintech and payments much before me. I would say a few years on me. And we kind of both had the same vision, or sort of an ugly understanding that technology is going to reshape financial services. And we have to be a part of it. We have to build something in that space. Initially, we were going to do something like a B2B cross-border remittance company or something. But then very quickly, we also felt that there is a need for creating like a watering hole for fintech or like a Bloomberg for fintech space. So Medici essentially was like Bloomberg for fintech space. Two parts. One, we had a platform where we were tracking about 17,000 fintech companies, and through a technology platform day in and day out. And then we were providing subscriptions to banks, financial institutions, fintech companies, investors, and so on. And then we had because fintech was we were very early in fintech, 2013 onwards. A lot of people wanted to understand what is SME lending, what is like underwriting, what is collections, what is B2B cross-border payments, and so on and so forth. So we had a blog. And we had a lot of other media stuff going on. So that company grew really well. We became a decent enough name in the fintech industry. A lot of people trusted our platform and insights. And basically in 2021, we got acquired by Proof, which is a multi-billion-dollar identity authentication fintech company out of US. After the acquisition, I actually became the country head to build the India business from scratch. So everything from product, tech, marketing, sales, the whole line.
Correct. Yeah.
And I did that for 2.5+ years. We were able to launch the products in the Indian market and everything. And then I realized that I should probably go and follow my passion, which was, into sort of helping early stage startups. The journey that I enjoy the most and where I'm able to add most amount of value is 0 to 1. And so, I would also say now I enjoy -1 to 1. From the ideation to the product also. And before leaving Proof for last few years, I was also investing a lot in fintech startups mostly, but in others as well. And have a pretty decent track record. God has been kind, and so. I thought that a good way to utilize my skill set and something where I'll find it really, I'll enjoy doing it and I'll be able to add a lot of value was sort of creating a fund. So started with angel investing, moved to a syndicate in India and US, and also a investment holding company in Singapore, and then now we are graduating into a fund. And there's something else I'm cooking, but that's kind of high level journey so far.
Amit has always been very kind with his insights. We were partners for Finstep Asia in our initial days as well. But beyond that, the first time I met him was strangely enough in Hong Kong when he had come down to do a presentation on India Stack, and it was mind blowing for a lot of people who were in the payments banking industry to hear about how India Stack and the whole piece around Digital India grew and how it's impacting finance and fintech broadly. So Amit, let's maybe take a not a detour, but try to build up on Indian fintech as a journey. And I want to, people like breaking down in decades, I'm going to use half a decade. So, the period of 2010 to 2015, 2015 to 2020, and then this 5 years that we're looking at, because it's been, evolved in a nice way, if you can think about the way. So, how have you seen that growth, right? And enablers in each of those semi-decades or half-decades as it is, right? I don't know what the right term is. 5 years.
I will not remember the events exactly by the years, but I'll try to explain the evolution. So, but I'll start from what Musheer was talking about. So it was very interesting, right? Between 2013 and 16, 17, I would go and speak at Money 2020 in US or Japan Fintech Week, and then the session we were kind enough to organize in Hong Kong and bunch of them, and I would talk about like India stack and what is happening in India with UPI, and people I think it was impacting only say people in hundreds.
Yeah.
And then I think something happened, right? And then Nandan Nilekani and the people who actually built all of this started going and talking at these conferences. Plus, I think Google submitted a paper to Federal Reserve saying UPI is like the best real-time payment system in the world. And then, I think it became like a global phenomenon, right? It was very interesting those times, right?
And kudos to Dilip and Praveena's team for how they built this stuff, right?
Absolutely. So I remember, since you mentioned Dilip, that very long back he told me that, and they were progressing really well. And
I'm just going to introduce, for the audience who don't know who Dilip is, Dilip Aspe is the CEO of UPI, which is NPCI, which essentially manages and runs the unified payment interface for Indian payments.
Yeah. So they were doing really well and they were growing, but Dilip was like, we need to do like 1 billion transactions a day. And we were like, really, we can reach there. Yeah. And now you see, like, we are pretty close. We are at 10 billion a month, 10, 12 billion a month, and very soon we will see 1 billion transactions a day.
Yeah.
So, it was very interesting. So, now, since you asked this question that how India fintech or India tech has evolved, I think credit goes to the CTO of the country, as he's called usually, Nandan Nilekani.
Yeah.
The gang. Of course, there are many other people involved, but I think. And also, I would give credit to the government as well, because what has been happening is that first they created bank accounts for everyone, right? The Jandan accounts,
right? Which literally translates to wealth of the people.
Yeah. Now, because you need to have a bank account to transact, everybody has a mobile phone, everybody has a connection, so that proliferation also helped. And then basically you have to find ways to take out the money so that people can digitally spend it. Yes. Then comes UPI. So everything seems like, it was so well planned and so well executed as well.
Yeah.
Like, I don't think it is easy for more than 1 billion people to get dual mode biometrics, right? It's a humongous task to get everyone a digital ID in that fashion, but they did that. And so now, if you put together Aadhaar, bank accounts, UPI, and all of these things together, mobile phone connections, this is a perfect setup, like the platform from where, mass adoption can happen. And I think Nandan has said this many times, that the only way to serve Indians in the remotest of the places or like this 1.3, 1.4 billion people is that you have to reduce the cost of delivery. The only way to reduce cost of delivery is through technology.
Yes.
And so that's why they have invested and they have executed this plan of. So that I would say is the base layer, and
obviously the India stack and the digital India.
Correct. And UPI. But then, if you were to say that what has happened on top of that, right? So we can talk about each of the different segments, right? So it usually starts with consumer payments.
Correct.
And P2P, P2M. So then a lot of QR codes everywhere, just like China, right? There are a bunch of companies which did that: Paytm, BharatPay, PhonePe, and so on.
These guys, yeah.
And then now people can transact digitally, accept payments, pay at merchants and all of that. So now you're talking about credit because there's a credit stagnation.
Yeah.
So a lot of unsecured lending started, and there are players who have built like huge businesses in India in that space. Early salary,
yes.
Credit B, Crazy B, Pocket Free, M Pocket. There's so many of them. They've built like great businesses in unsecured lending. and BNPL, and allowing people to purchase the iPhones and the Android phones using credit. So that has been going on, and then at the same time, NBFCs, MFIs, banks have adopted a lot of technology as well.
Yeah.
Neo-banking, I don't think has really taken off this country, and the reason is there's no Delta 4, right? So the difference between like an Indian neobank and an India private bank experience is probably like a difference of like 30 to 50% if at all. But if you go to some other countries where neobanking has taken off, there is a Delta 4 difference,
Correct. Yeah.
like your Brazil or Saudi, places like that. Then I would say also in investment space, like digital brokerage firms with newer way to price it has worked very well, where people are, traders who are making a lot of transactions, Zerodha offered them, fees which would actually help them a lot. And then digital transactions, you can do it pretty much real time. So if you see all the 5 platforms, digital brokerage, they're all making good amount of money. A lot of them are profitable.
Yeah.
So Zerodha was profitable, but now Grow is profitable, Dhan is profitable, and so that sector has performed very well.
Zerodha is also bootstrapped, by the way, like no VC
Yeah.
investment per se.
Yeah. Then there is B2B fintech, because the banks in India are quite progressive, in that fashion. Like, first of all, the technology lag between them and some of the fintech is not that big as it is like in some of the other Western countries. But then they have been working with fintech, and unlike JP Morgan or some of these banks in the US, Indian banks do not develop like full platforms or solutions within the bank. That rarely happens. So they have always been using big vendors, IT services firms, but then a lot of that IT services switch to products from fintech companies. So B2B product companies have done actually quite well. Perfios is a classic example. I think the pivotal moment was when the most traditional and the biggest private equity firm, Kedara Capital, invested $29 million in Perfios. That's a turning point, right? Because now you're seeing like traditional money coming into like fintech markets. And I actually met the CEO of Perfios, Sabyasachi, and I asked him like, you have done a lot of great things, but what is the one thing you feel that people still don't do or don't get it in the startup world, which you have done differently? And he said, for the first so many years, we did not raise money from VCs, and we just kept focusing on the product and the business, not on like a typical founder spends like 40% of the time on fundraising,
Correct, yeah.
right? And giving the updates and pitching and raising money and the paperwork involved. He said we were completely focused on building the product, getting the customers. After we build a great business, then we started going directly to private equity and basically raised a lot of money.
Yeah.
That too in the last few years, if you see.
Yeah.
Great learning, the way. So anyway, so there's B2B fintech which has evolved.
Yeah.
And I'm sure I'm missing some segments, but you get a picture.
Yeah. I think one of the key things I see from the India fintech growth, right, and as you're saying, the five years, as you rightly said, the first 5 years we can say was the infrastructure build, right? Where India Stack came in, Aadhaar, which is India's biometric program, and it has covered over 1.2 to 1.3 billion people are on it, right? Seamlessly, to a large extent, without much pain, and very, very cost effective, right? India was, when it started out, was probably $1 sub-trillion economy, to now we're closer to 3 trillion, but in the start of the decade, we were still around $1 trillion. So you can see that for economies that are growing, emerging, it has become a market. And second became the mobile data conversation, right? I very rarely want to use the term democratization of a product or of something, but I think Jio in particular, when they came in, Reliance Jio, they democratized data with 10 rupees, which is approximately about 12 cents US dollar per GB, right? That made it easy for everybody to access the internet, and you would get these low-cost handsets, a lot of them Chinese manufacturers, but also the ones from like Samsung and others building, which serve this segment for $100, $200 US dollar segment, right? And I think that was a key element of that coming together of infrastructure being built, and as you said, the other infrastructure being the data build, which from 2015 to 2020, you saw the doubling of India's internet users from under 300 million to over 750, 800 million internet users, right? And that's growing. And plus the Jan Dhan account, which was about 500 million accounts for those who did not have. So then you went from being quite a low banking penetration to a highly banked country, and it was just basically providing the base layer. They didn't need to effectively use their bank account much, but they had the money being deposited in their bank account, which they could then use the likes of UPI, which are built on banking rails essentially. And then we saw this big spurt when COVID came and everybody had to go digital. And I think it was important that if we didn't have these two layers in that 5 years period, that spurt would not have happened.
It would have been
difficult. I mean, demonetization was also played a part of enabling people to use more digital money, but I think this was a seminal moment. Now, coming to this last 3-4 years, I think we've seen supreme waves, right, where every other week was a unicorn. In fact, if you look at 2021, 2022, you were having a unicorn, 2 unicorns a week. We reached 100 unicorns in that period. But you also saw very high valuations. And then came the slowdown, and but India still happens to be kind of one of the leading players when it comes to funding. Now, I want to talk about that process, right?
Yeah.
India did not see a Fintech IPO till about a couple of years ago, and that was Paytm after 12, 13, 14 years of being in play. Whereas in China, you'd see on average people are getting in and having an IPO in 3 to 5 years. Right?
Yeah.
So has that capital investment cycle matured? Because what I saw from a Hong Kong, China perspective was when you're getting in early, people were exiting quickly, so they had returns that they could go back and put because they've seen the whole return cycle. So do you see, from an investment angle, and you've seen that, right? You've seen the angels, you've seen the unicorns you've invested in, to now those going and listing. Yes, a handful, but it's looking like more in the pipeline in the coming years. So how have you seen that evolve? You mentioned about Kedar and the private equity, real world cash coming in versus the VCs. How have you seen that evolve?
Yeah. I think in fintech, especially on the consumer side, in India, what happens is that you have to invest a lot in changing the consumer behavior through lots of offers, discounts, coupons, and a lot of infrastructure have to be built, like deploying the POS and QR codes and all of that. So I think VCs and PEs have played an incredible role in that. But a lot of them have big portfolios and they need to see the returns. And the last 2-3 years have not been helpful. A lot of companies have either gone bust or are going out of business. And so almost like the entire industry had to relearn one basic thing, that the purpose of a business is to generate profits, right, and make money. And I know, right, like sometimes it feels like all of us have turned around and have started preaching while we were all a part of it. So that is fair. I think that is fair. But then some investors had a slightly different take on it, and some were more aggressive, right? 21, 22.
Yeah.
I think with Paytm, Policy Bazaar, and bunch of them like Digit, etc., going public, we are now seeing returns coming from public markets. Also, something that nobody looks at, and I have been posting a lot on that, is the SME IPOs.
Yeah.
So I would say like 3 or 4 companies decided to not wait forever, right, for 10, 12 years to go public. They are saying like, can we go to the public market but at a smaller scale and raise money? And then, by the way, they have like 10 crores of revenue with like, more than $1 million, $1.5 million. And then you are profitable, but then you go and raise money from the public. And then if you want more money, you can do FPOs, and then one day after 3-4 years, you can go to the main board.
Correct.
Just like there's Zomato and Paytm are, right? So that journey I find very interesting for a lot of companies, especially I feel B2B software companies which are supposed to have great gross margins and net margins. They can be profitable by the 4th year, and they can have like a decently successful B2B fintech company in India would have 10 crores of revenue, right? If they don't, then there's a problem.
Yeah.
And then if you're profitable, you can actually go and raise. And then everything that I have seen, right, whether it is, you look at Trust Fintech, which is like core banking for small banks, or you have NPST, which does a lot of infrastructure play, B2B infrastructure play in the financial service space, or you look at the cybersecurity company called Tech, and so on and so forth, right? So there are bunch of fintech / tech, IT service kind of companies in the financial service space which have gone public on SME IPO. I think it's a great outcome. They're all doing very well. If you look at their returns and the stock market performance, it's actually pretty good. So that is very good. Like that's a new exit option which has come up. It may not fit the typical VC cycle because VCs have this whole power law that maybe 2 out of 20 companies will perform, but they'll perform so well that they'll give them like a 50x return. So at that SME IPO level, you may not see that. So they would continue to wait like Paytm and all that, for much longer. But I am fine. Like I am, my like one of the things I am trying to do is that can we identify good companies and fund them enough so that they can hire the resources, get the AWS and the LLMs and so on, and then go and like become profitable in 4 years, generate 10 crores of revenue and go SME IPO. Why do you need to follow something else? So that is something I'm excited about from a exit standpoint that you asked.
Yeah, so you're looking at enabling infrastructure, if I may use that term broadly, right? And giving them the tools versus saying, here's money to go acquire, which I felt was the theme in that during COVID times, where you were not only seeing valuations quadruple, in some cases it was 10x of something within 6 months to a year, right? And then this very steep fall. And it's not just an India story, it's a global story. You've seen Stripe, Klarna, a bunch of others, their valuation falling by more than 50-60% or even further.
Yeah.
Why do you think there was this whole rush into all these unicorns and creation? Was it FOMO or was it beyond or waited? So let me rephrase that. So there was this rush, all of them came in, right? Why did not follow through? Right?
Yeah.
What do you think was the reason, and why are we seeing a lot of companies go out of business in such a short period of time? It's not even 3-4 years, it's just a couple of years. So what was that? What has happened?
I think the 3-part answer. One is of course the ZIP era, right? So there was too much liquidity and very cheap capital available.
Sure.
A lot of people raised money. Like I know there was this whole angel list based rolling funds in the US where people raised like $30 million on Twitter, right? So there was money chasing these companies, and then I remember somebody sent me like a crypto company deck and said they are raising at $20 million and they had no product, no revenue, nothing. And then I said, no, I want to talk to the founders, and the person said, no, but if you think first and then invest, that's fintech. If you invest first and then think, that's crypto. And I said, okay, I'm out. So what happened is that a lot of people decided to start up because they knew that there's a lot of funds chasing to few good companies.
Correct.
And the ZERP era and all of that helped. I think there were a lot of tourist entrepreneurs, which got into the market, and there was.
That's a tag for you guys to remember. Tourist entrepreneur. Yeah.
They were. I don't think they were fundamentally good products or good business models. In fact, once you get money like that, right? If you have a deck and you have no product, no revenue, no plan, and you raise $20 million valuation, like $3 million, what happens is you start developing bad habits right from the beginning. So what happens is you would know that I have $3 million and I don't even have much cost, so let me spend like a lot on customer acquisition because then my numbers will become better and then I can raise the next round, right?
And where VC is primarily looking at customer acquisition numbers as a metrics?
That time it was all about user growth, number of users, all of that, right? Yeah. So you could fund that customer acquisition and at very high cost, which was totally unsustainable in the long run, right? Now, you could argue that when Paytm built such a big business in India and a brand, and they acquired all these consumers and all that, capital was cheap, there was liquidity, they could raise that money and do that and build a national brand, which today it is not possible. So if somebody wants to build another Paytm now, it's 10x harder to do it.
Correct. Yeah.
So I would not blame the entrepreneurs, right? The money was there, liquidity, capital, cheap capital.
Sure.
So people took money, but then there has to be at least some method to madness, I felt. So those who were able to get a good product to the customers, don't develop like very bad habits, kept the customer acquisition cost under control, build a good business model, they are surviving. In fact, they're thriving today.
Yeah.
Right? There are so many companies we can talk about. And that is, I think, the answer to your question. What happened then was a mix of a bunch of these things.
And this is maybe a fundamental question, or some people say stupid question, but investors, right? they're supposed to have a good sense of it. And we're not talking about just somebody who overnight became an investor. The zero interest rate regime has been around for over 10 years per se. The money was flowing. This sudden bump up, but you had big names also chasing these unicorns and decacons, as some of them became. And why? I mean, that keeps befuddling me, because I used to say, like, I can't see the justification of something going within 6 months to 9 months 4 times. What has changed? The numbers may have changed, but how?
Look, one thing which people have to understand about startups raising money and VCs and fundraising is that there is no underlying principles on the asset itself, like how is it valued. It is between the buyer and the seller.
Sure.
Right? So, for example, if a fundraise has happened at $10 million today, and I'm the next fund in line, and I really like what they're building, and I trust the fund which is invested and everything, right? I can come and market up from $10 million, $20 million to $50 million. If I want to put the money, who can stop me, right? And if I have the money.
Yeah.
So it's between the buyer and seller, and that's what happened. Like this, that's why I said, right, zero, low cost of capital, liquidity. What happened is the smaller funds became slightly larger funds.
Yeah.
Large funds became very large, like $1 billion, $2 billion AUM, right, became very common. And then, as I said, right, early stage, a lot of people entered and started and raised like 10, 20, $30 million. All of this and the buyer-seller concept I'm explaining, this is why it happened.
Okay.
Now, there were people who were very careful, and I'm not saying that we did not make the mistakes. We also made a lot of mistakes, but the only thing was that very early on, because of the work we did at Medici, I understood that B2B infrastructure in fintech is a much better play for me.
Sure.
And I also grew up in that world, enterprise, B2B and all that. So I have made about 30-35 investments. About 90% of them are actually B2B infrastructure, API companies like M2P, SignZ, Discovery, Hyperface, so on and so forth. And what happens is that the consumer companies in fintech are kind of the probability of success is very low,
sure.
and the mortality rate is very high, right? For higher cost of customer acquisition, and things change very fast, regulations change very fast, right? So, as an example, one of the leading sort of company which attested the credit line to a prepaid card, right? Because the regulation changed, they went out of business very quickly. But the infrastructure company which is supporting them is still in business. In fact, they are getting back and growing now, right? So that is something that I always use as a judgment. The second question that you asked, right? VCs are supposed to be good at this, right? Like I would say, one of the key skills that a VC or an investor needs to have is a good judgment.
Yeah.
Right, because there's not much data to play in the early stages. Yeah. And private equity guys have this advantage that they can do the same kind of financial analysis that public market investors do, right?
Yeah.
And there's a lot of metrics and data available, and you can go and talk to like so many customer surveys and all that. In early stage, there's hardly much to see. Yeah. So you are basically betting on the founders first. Then you are betting on how big can this thing become, and then you are also betting on whether there's a good business model to be built over there. So you need to have a good judgment of all these three things without having too much data. I think that is where it's a make or break. Like I don't think it is for everyone, and I don't think that everybody has been successful at doing this.
Was it a spray and pray?
There was a lot of spray and pray. So there are investors, especially in India, who, and this is very public knowledge, right? You can go and check. Like there are investors who put money in like 150 companies and 200 companies, and I would still say that, let's say 5 or 10 of their companies perform, they'll still be fine, but yeah, if you look at individual companies, a lot of them would not survive.
So now what I'm hearing in the market beyond the story of obviously the companies closing down or shuttering or up for sale, which I think is a significant part of the market. Not out in the open so much. There was a couple of articles last month which spoke about it, but not too many people talking about it. Still, do you think that phase is done, or are we still in for some more pain with companies collapsing or having to be acquired by others in the coming months?
Look, people thought like 20 months back that everything will improve in 18 months.
Yeah. So
it has not.
Yeah.
So I would say that the pain is still ongoing. there were, again, sorry to use this term, but again, there were a lot of tourist entrepreneurs who thought that they can raise some money and they didn't do the research. They did not have a very clear understanding of how things will play out, whether this business model will work or not. They created products, they did not work out, and then they were also pretty swift enough to close down those products and close down the companies, and now they moved to greener pastures, right? Like recently, I came to know that one of the very glorified new age school has closed down, and now they have found something in a more in a greener pasture on the AI side. So this is very common. This will continue to happen, and then there are some businesses which, just because the environment has changed so much and the cost of capital has gone so much, and there's no even though there's a lot of dry powder available with VCs, but what I've heard is that if you don't do anything, then you won't make mistakes. So if you don't do anything, you don't make mistakes, then you can't be blamed, right? So people are just going very slow, people are calculating, people are looking at all the metrics, everybody has become a Warren Buffett, and so there's a 5x more due diligence which is happening even at early stages. And look, I'm not saying like we used to do it very different. We used to do it the same that we did before. We have also changed, we have also learned, and everybody has learned. So it has become very difficult to raise money if you do not have a solid plan, if you do not have the right background, and if you don't have a great product in the market.
So what is 77 Capital looking at, right? And what do you see as investable sectors in the coming fintech and VC? And this is not investment advice. Please do your own research and follow through with your own calculations before you invest in anything. We're getting a sense from Amit on how he looks at and 77 Capital look at their
Thank you for the disclaimer, very important.
Yeah.
So the last company that we invested in, it's a company called MileAway. That's a very good example to show you like what are we looking for, right? It's a typical payment software company.
Okay.
They are in the back end, the dirty, the messy back end of payments on the merchant side, right? So what they actually, the founders spend like 40 years of combined experience in companies like Wordline and Hitachi Payments and all that, and they looked at transaction monitoring, transaction reconciliation in the back end of payments, which is something that was highly ignored because most of the stuff in payments in any country happens in the front end, which is issuing side.
Correct.
That's glamorous. That's where big companies are created, consumer side and all that, and then PGPA and all that. But this is like for them, the customer is actually PGPA, right? So they do transaction monitoring, transaction reconciliation, and then they want to build an acquiring switch. So we invested. They were already profitable when we invested. So you can imagine, right, that the experience of the founders, the product itself. Because of the understanding we have, we were able to do the proper due diligence of the product. It was already deployed in a lot of big PAs, so we were able to do customer due diligence, and also they were profitable, right? So that's the kind of investments we are looking for. Again, my theme for last 4-5 years has been B2B infrastructure, API, companies which power, consumer businesses, and any company can be a fintech company, right? Those kind of, companies. I would also say that second very important point is that we have started venturing out. We had started venturing out outside of the fintech, from 2022 onwards, and we have made a series of bets in SaaS, B2B software, AI, Gen AI space, and we are actually doubling down on that. So I think in the next few years we will probably see more investments in these spaces than fintech. And we can go. I know your next question is going to be why, so we'll come to that. The third piece, which is very important, is then I'm not able to kind of disclose it fully today, but I feel that there's an opportunity to actually build in the AI and generative AI space, where I think you would want to go even earlier. That's why my comment about -1 to 0 and 0 to 1. I think we would like to take certain things from idea to product and product to the market by funding them, but also sort of helping build. And I'm collaborating with a couple of AI researchers and people who are building the GenAI space.
I was going to say the awesome Indians at Amazon employed for their AI for their automated stores. That's a joke. There are 1,000 Indians at the back end. And it's an interesting thing about AI. I mean, AI is nothing new. We've seen it in 40, 50 years. Millennium Capital was using AI for investments in early 80s, and a variety of different applications have been seen. Now we're talking about the Gen AI.
But it's very different, Musheer.
Yeah, now we're talking about the Gen AI and LLM conversation.
Yeah.
My key thing I feel, and I would love your comment on as you're looking, you spoke about researchers. In India, I have seen, some of it from outside of it, some of it experiencing it myself when I'm in town, is that it's a lot of products being built, a lot of innovation, but in terms of deep tech in the fintech space and others, we haven't seen so much go in. And you can look at Amazon and all the others, Google, Facebook. There's a huge amount of investment that, yes, these are the top companies in the world, yeah, but even otherwise, we look lower down the ladder in the US and also in China for that matter, there's a significant amount of money spent on top talent and on research and that building deep tech, right? Are we now at that stage where, are these growing shoots for the Indian fintech ecosystem on AI and other elements where we can go into more building deep tech for this country, which I think we've gone beyond that space where you could do generalized copy paste from other ecosystems, be it US or China, and grow to a certain level. But now, given our 30 odd states plus the different languages, so making it localized is becoming a theme from what I started noticing. So do you see AI enabling that? And plus, on the research side, where are we on the journey as an ecosystem?
So I'll try to be as quick as possible.
Sure.
Lot to uncover in that question. There are three parts, right? One, I think last 10 years of fintech in India, we have seen a lot of distribution play. So if you see any of the large companies, I don't think anybody has really developed a deep tech fintech product. I think also because of the India stack, a lot of stuff that companies would have built as IP was already built. Like what a typical Visa, MasterCard, PayPal build, we already have it through NPCI and the likes, right? So there is that, but also because distribution is so difficult in India, people raise money and try to crack distribution. So Paytm, PhonePe, you look at anybody, like any of the big companies, they have cracked distribution, right? So they're distribution-led companies in India. I used to meet this pizza founders in different money. I always wondered why don't we have a really seriously good fraud detection prevention company from India based on machine learning, other things, and some expertise. And there's a lot of domain expertise in India.
Correct.
In many of these segments. But again, it's the risk reward, right? And the amount of time it takes to develop a deep fintech solution, which I think in cybersecurity, fraud detection, prevention, other areas make a lot of sense. We have not seen that enough. I think now we will start seeing. The other reason for that, I feel, would be that if you look at non-fintech deep tech companies in India, they are doing pretty well, from Amit Goel and all that space tech companies, or like companies like Gen Robotics in cleaning, scavenger type stuff. All of that, they are finding local market. So there is defense and government and local corporates actually buying stuff from deep tech companies. So they are generating revenue, they are raising money. There are so many deep tech funds from early stage to late stage which have come up. I feel we will see some of that in fintech, right, which has not happened in the past. Now, if you sort of disassociate AI and Gen AI from that, right? We saw a lot of ML, NLP based products. But then Gen AI is very different. And I can tell you firsthand because we have been dabbling using technology, developing something which is going to be out in the market pretty soon. And we realized why people are actually very excited about Gen AI like me is that it reduces the cost of development significantly.
Correct.
We are going, I think, using Gen AI and software which asks AI to do stuff, including actions and all of that. We are talking about what used to take 4 engineers 6 months to develop a SaaS solution. Now that can be developed in 6 to 7 weeks and then some fine tuning and all that, right? So cost, time, all of that reduces, and a lot of software will be written which will be telling AI to do things, right? So that is the big leap, I feel. And so somebody was telling me in SaaS Bhumi, the discussion was everything which has been developed in software and SaaS is up for grabs now. It will be rewritten, and if you listen to Aaron from Box, he talks a lot about how they are using it internally in the company. And similarly, the use case that we have found, it's incredible that this was not possible before in the last 20 years. What is possible today with that? So really excited about what are the possibilities. And I think what will happen in India is, I don't think we can compete broadly, right? There's been a lot of discussion about that, but I don't think we can compete on foundational models. A GPU costs like $9,000, and you need a lot of investment to actually do those kind of things. The first wave, even everywhere, if you see even in the US, people were trying to build like this. They wanted to create a finance GPT and a medical GPT and all that, and train the data. But the problem is, by the time you train the data, and this is a model that you have to take offline, train the data, by the time the LLMs itself from OpenAI and all that develop so much that now you have to think about, like, are you betting against them? I don't think it's a good bet to bet against OpenAI LLMs and the leading LLMs. Yeah. So you would rather build in the application layer, which is what I think a lot of people and developers are going to do. And the fantastic applications by doing tooling, prompt engineering on top of the LLMs, and you can achieve the results. And it's not just about fancy pictures and videos. You can actually do actions now.
Yeah. Okay.
So very excited.
So it's an exciting space. I guess that's what it's going to be, as we build on as we collaborate potentially with some of the other players. And you've seen Microsoft having a big interest in growing in the ecosystem, as is Google, as well as Meta and others who may not necessarily have the same access in the other big economy in the region, being China, right? Yeah. Amit, it's been a pleasure. Any final thoughts on fintech investing for our audience? Very keen to understand this. Yeah.
I would just say that even when we were building Medici, nothing against VCs, but I think we never went to VCs to raise money. We raised money from angel investors, basically like top 5 guys at Barclays and MasterCard and all that, people who understood financial services. And so that we could take less amount of time in raising. The main reason was that, right? That we could actually focus on the product and the business. And similarly, I think people should first focus on what is that you're building, what problem are you solving, what is the product, and then what is the market, and talk to the customer. Spend all the time between your product and the customers, and not on like 30, 40, 50% of the time on what should be my fundraising tactic and what should be the deck. There was a guy who came to me, and this is one example will summarize everything which is wrong with the entire this whole VC ecosystem, is that there's a guy who came to me and he's built an enterprise AI solution in the financial service space, which should be costing around $3,000 to $4,000 per month for a client, and he was offering it at $175 to a couple of enterprises. And I asked, why are you doing that? He said, because I went to VCs and VCs said I need to have some traction and some paying customers. So I thought if I offer it $175, I'll get a few customers and then I can go and do the fundraising. And I said, but sir, do you realize that the purpose of your company and you is not to just fundraise? The purpose is to actually develop a good business and generate profits and develop generate revenues. That is what is like terribly wrong. I think my one word advice will be focus on revenues and customers.
That's the old school way, right? Focus on money. People invest in if you're making money, and as you generate revenues, that can also fund your growth. In that perspective. Yeah. Fantastic conversation, honor and pleasure as always.
Thank you, Musheer.
Thank you for being on the Finstep Asia Edge podcast. Audience, stay tuned for more interesting and very deep conversations on fintech, virtual assets, and the future of money here on the Finstep Asia Edge podcast. Like, subscribe, and follow our pages for more content. Thank you.